Hi guys. InvestorX is back again with a new useful video. In this video we will learn about what are bonds and how to buy them. We will be explaining in detail what bonds are, difference between different bond types, diversification of bonds based on their qualities, and much more. So, let's start with the basic introduction. Bonds are loan which is given to a company or government by investors. In return, investors get regular interest payments decided by the organization. The initial amount is paid back at the end of a set time, also known as maturity. Bonds are very useful during a market crash and for one who wants very low risk. Now let's see the advantages of bonds. They provide a steady income through interest payments. Also, they are safer than equities, making them ideal for conservative investors. Help balance risk in an investment portfolio. They are often used to diversify our portfolio. There are three common types of bonds: government bonds, corporate bonds, municipal bonds. Government bonds or government securities are very safe, as they are backed by the government. Corporate bonds have higher interest rates and are slightly riskier. Municipal bonds are issued by cities. They are useful for investors regarding tax purposes. Let's talk about how bonds work. Here you can see a diagram which shows the functioning of a bond. First, the investor finds a desired bond in which he wants to invest. Then he invests the capital which is regarded as a loan. Now bond issuer or that organization issues a bond for that investor and pays regular interest to him. And at the time of maturity the initial amount is returned back to that investor. This is a bit detailed version of how bonds work, with some useful keywords like principal amount, coupon rate and maturity date. Now let's talk about different risks related to a bond. Well, bonds come with three types of risk: default risk, interest rate risk, inflation risk. When an issuer may fail to repay the initial amount is known as default risk. Rising rates can compress the value of bond known as interest rate risk. Inflation may reduce purchasing or buying power known as inflation risk. Here is a detailed bond comparison between EE bonds and I bonds. EE bonds. Current interest rate is 2.6%. As of January 2025. EE bonds you buy now have a fixed interest rate that you know when you buy the bond. That rate remains the same for at least the first 20 years. It may change after that for the last 10 of its 30 years. They guarantee that the value of your new EE bond at 20 years will be double what you paid for it. I bonds. Current interest rate 3.11% as of January 2025. This lasts for 6 months. I bonds earn a rate that can change every 6 months. The rate is a combination of 1. They have fixed interest rate. 2. An inflation rate that we calculate twice a year, November, May. They guarantee that the interest rate of an I bond will never fall below 0. Now let's see about bond diversification. Here's a detailed chart which shows the rating of bond given by S&P and Moody's. AAA bonds are of lowest risk and they are highest quality bond. AA bonds are of low risk and come with slightly more investment risk. A bonds are also of low risk but come with many positive investment qualities. BBB bonds are of medium risk, but have efficient security. BB bonds are of high risk and have moderate level of security. CCC and CC bonds are of the most highest risk and are poor quality bonds. C and D bonds are of in default risk and have lowest rates given in bond class. Finally, bonds versus stocks comparison. Bonds offer stability, however stock are well known for providing higher growth potential. Bonds have fixed interest rates and stocks pay dividends. Bonds have low volatility than of stocks. So, let's start with the practical demonstration of how to buy bonds and bond ETFs. Now on my screen you can see that we have one ETF named Franklin Canadian Short-Term Bond Fund ETF. It is managed by Franklin Asset Management Company. This ETF buys Canadian bonds of short-term duration. Here we can see that the current net asset value of this ETF is 19.26 Canadian dollar. The past 1-year return for this ETF is 7.11%. And 3-year return is about 3.07%. Bonds generally have lower returns as they are one of the most safest financial instruments in the market. People generally buy bonds during a market crash or in overvalued market prices. Here we can see that this ETF invests all the money in energy sector. As Canada is one of the leading countries for energy production, so it's a profitable and safer sector for investment. Now, let's move towards one more ETF named iShares Flexible Monthly Income ETF. This fund is being managed by BlackRock Asset Management Company and currently floating on a net asset value of 41.85 Canadian dollars. We can see here that the past year return is 4.73%. This ETF invests major our money in communication services, which is by 88.57%, followed by industrial zones with 5.71%, real estate and healthcare by 2.86%. This ETF's top holding is BNC, which is the same ETF but for US market traded at NYS circa at the current NAV of $52.34 US. This ETF has got 6.6% returns in past year. And here we can see that this have almost same sector weightage of XFLI. Now let's move towards our last ETF, which is iShares iBoxx Dollar High Yield Corporate Bond ETF. This is traded in US market and being managed by BlackRock Asset Management Company. Here, we can see that this ETF has given us 9.68% past 1-year return, 1.3% in year-to-date, which is about 2 to 3 weeks, and 3.4% in last 3 years. Here we can see that the 0.41% holdings are XTSLA and rest of 99.71% holding goes into utilities sector. Now let's see how we can buy bonds officially from US Treasury website. It's the official website from where you can buy a bond according to your need and risk. All you need is a registered US bank account and a social security number. By which first of all, you need to fill the form to open an account, then you can buy bond on your respective time and rate. Here are 20 and 30-year bond with 4.625% and 4.5% return per annum. We can also see the daily auctions and rest of the stuff here for that bond. You can also buy EE bonds which guaranteed to double in value in 20 years. You get fixed income our current rate of 2.6%. Also you can buy I bonds which is used to protect against inflation and its rate of interest changes every 6 months. Currently it's 3.11%. Rest of the details you can see here.